I think it's important here, like when we want to think about our investment blueprint, there's a couple of things which we want to think about first. When it comes to investing, the first thing which we want to think about is, okay, how much um, target returns or portfolio size or income which I want to achieve, right? If I don't know what's my dividend income which I want, it's okay. You can start thinking about, okay, what's the end goal or the target portfolio which I want to actually achieve for myself. And then from there, at this current stage, think about how much of a starting capital which I want to start contributing, start putting out for investing. Because a lot of times I think where you get stuck, right, is when we get started investing, we don't sit down and think about, okay, how much capital do I want to start off investing with? And a lot of times we will think about, okay, I have some money here, so I just take and I'll start buying some stocks. I have some money there, I'll take some money from some other account, I'll start buying stocks. So we don't sit down and calculate exactly how much is our starting capital, because this is important because we have to treat investing like running a business, right? We want to know what is our startup capital. We want to record our revenues, our profit and losses, right? Our profits are the gains and the dividends coming from our investments. The losses are basically the losses which we have to cut loss from investing in these stocks. So overall, you want to have definitely overall you want to have a positive P&L. But more important, you want to treat it like a business such that you want to know what's your starting capital here. And that's the first and most important thing we should going to understand. Because if we don't do this, right, what we are going to find ourselves psychologically is going to be very overwhelming. Things are going to be it's going to be very messy. We don't have a step-by-step process on how we actually build our portfolio. Because when we know our starting capital, we know how much it takes to actually get there. So say for instance, right, let's say your starting capital is $100,000, right? It could be $50,000, it could be $150,000, it could be $200,000. Let's say we start off with 100K, and let's say we give ourselves a 10 years horizon to start investing. Right? So at the end of 10 years, ending value $100,000, right? Of course, when we start investing in dividend investing, the average returns which we get from the stock market is about 10% per year. But for dividend growth investing, it's slightly different. If you want to focus on individual stock picking, you can actually get somewhere between 15 up to about 20%, right? 20% is a little bit on the high side. 12 to 15% is more conservative. So if let's say we expect ourselves to get about 15% a year on average. So I'm not saying that each year, next year will be 15% or every year is 15%, but on average, at the end of 10 years, the average return you would probably potentially get will be about 15% per year, right? So this is the expected increase which we set for ourselves. Then of course, more important, if you look at step 2 here, is the annual contribution. I think what's important for investing is not just working with a starting capital. We also want to continuously put money into the portfolio and grow it over time. And you can see the big difference is, let's say if we have put in $1,000 each month of our salary, of our earned income into the portfolio, is about $12,000 a year, right? So ending value should be about $600,000. So it depends on what your starting capital is. If let's say your starting capital is lower, right? Then we want to think, okay, how am I going to achieve, let's say, if you want to achieve $1 million goal, you'll probably need about 15 years, so slightly more, right? So this is how we want to actually play around with this. And of course, think about dividend investing. You probably want to invest for a start because as a dividend growth investing strategy, the yield will be lower. So you roughly look at about 2 to 3%. So conservatively, I'm looking at about 2%, right? At let's say $100,000 over the next 10 years. Okay. So in this case, $100,000, if I can put in $1,000 every year and investing this contribution as well, and I look for stocks on average, I look for stocks which are yielding about 2%, right? And I'm focused on, let's say, an expected increase of 15% per year. So this 15% is only the share price returns. It doesn't include the dividend yield. So do take note. And I reinvest whatever dividends back into the portfolio. So I click step 6, drip, to reinvest it over the next 10 years. This will be my target amount which I set for myself. Right? So if you want a higher target, then of course you can either increase your starting capital, you can increase your annual contribution, or you can increase both your dividend yield and your expected increase, your expected returns. So step 3 is the expected annual dividends on your portfolio. So if I put step 3 as a 2% um, uh, expected annual dividend yield, what this means is that overall, if I calculate my basket of stocks, on average, it will be about 2% dividend yield. So this is how I'm looking at, and this is what I'm expected. And it's a very conservative number. I can look anywhere between, for dividend growth investing, it can be anywhere between 2 to 4%. So this is the time horizon of our investment. So what this means is from step 1, maybe I'll just go through. Step 1, let's say you are putting $100,000 today as a starting capital. Then I decide from now, every month I put in $1,000 of income into the portfolio. So that is $1,000 times 12 months, that's $12,000. And I expect a dividend yield of about 2% on this portfolio. That means I buy, a basket of stocks. And on average, it gives me roughly about 2% plus minus. And I'm expecting these stocks over time to earn a return, or an average return about 15% each year over the next 10 years. And then, of course, the last step is I choose whether I want to reinvest these dividends. So the beauty is that it's okay. I don't reinvest those dividends. I take out the dividends to spend. That's fine. But the true power in compounding is basically whatever dividends which I collect, I reinvest into the portfolio. You can see that that actually increases substantially. It becomes clearer. There is a more targeted return which you want to achieve for the portfolio. So it makes it, in some ways, more disciplined and more motivating for us to actually work out step by step. All right. So let's say, right, if you have $100,000 capital, let's say if you can put in more capital, you can actually contribute more. Let's say at $2,000 per month over the next 12 months for every year. So you sort of religiously put in consistently and try to grow it. And let's say if your targeted returns over the next 10 years, you're trying to aim for, let's say, $1 million from this $100,000, then this is the projection which you want to actually focus on. So you might think, like, you might ask yourself, okay, this is probably the portfolio you're trying to build. That means on average, the portfolio should be about a 2% dividend yield. That means I want to find stocks which are able to actually grow, be able to grow, to be able to have a dividend yield of about 2%. And also the stocks are able to actually grow at about, on average, 15%, right? So that means your basket of stocks, it could be about between 25, 30 stocks, 35 stocks. Some can go higher than 15%, some lower than 15%, but on average, this portfolio should net about 15% per year for the next 10 years. So that means when I look back after 10 years, on average, this portfolio would have gained about 15% per year, right? Some years can be higher, some years can be lower. Should the total final capital include the annual contribution, so final dividend yield will be lower? Yes, of course. So that means if you look at this particular calculation here, your annual dividend income is about $20,000. So that divides by $100,000 plus 24,000 times your 10 years, right? So this is how it should actually look like. Okay. Then, of course, at the end of 10 years, you can always trade out some of your stocks which might have a low dividend yield for higher yielding, for stocks which have a high dividend yield. Right. So this is actually very fluid. It's a very fluid dividend strategy. Right. So every year you check back, you see whether you have met target, you have met that goal, and then of course you revise your blueprint. But more importantly, it's also saving. The time I got onto CNA, the time I spoke about looking into building a portfolio, right? I did mention, right, to diversify looking into the US market. But I think what's more important, right, if you look at one suggestion is actually to contribute more money into the portfolio as your earned income comes in. So if you're still working full time, great. Now's the best time to sort of control spending to try to maximize savings so that you can actually put more money into your portfolio. This not only helps to reduce pressure to outperform the market, but it allows greater margin for error. So I think the key thing here is not just looking at the returns, but also to also save up as well.